You have a silent business partner. He owns 30% of your retirement account. He decides when you have to sell your assets. And worst of all, he can change his profit share whenever he wants. You know him as the IRS. But what you don't know is that he has set 5 specific traps in the tax code designed to trigger exactly when you stop working. Most people think their tax rate drops in retirement. This is the single most expensive lie in financial planning. For many of you, your marginal tax rate is about to double. And the math doesn't make sense until you see the provisional income formula. Here's the reality. You aren't just taxed on what you withdraw. You're taxed on the interaction between your accounts. Welcome to Retire Rich. Today, we're exposing the 5 tax traps that could wipe out your retirement income in 2026. So, be sure to like and subscribe to stay up to date on how you can stay ahead of the tax man. The first trap is what we call the Social Security Torpedo. You've been told Social Security is a government benefit. But the moment your combined income crosses a specific, incredibly low threshold, that benefit becomes a tax liability. Here's the mechanic most CPAs miss. For every dollar you pull from your IRA to pay for a vacation or a new car, you aren't just paying tax on that dollar. That single dollar forces 85 cents of your Social Security benefits to become taxable income. Effectively, you're paying tax twice on the same transaction. You think you're in the 12% bracket, but when you add the phantom tax on your Social Security, your real marginal rate spikes to over 22% or even 40% instantly. This is the torpedo. It hits without warning because it doesn't show up on a standard tax table. But the torpedo is manageable compared to the second trap, the widow's penalty. Couples plan their retirement based on 2 Social Security checks and a married filing jointly standard deduction. But statistically, one spouse will die years before the other. When that happens, the household income usually stays the same. The survivor keeps the assets, but the tax bracket cuts in half. The survivor is suddenly shoved into the status of single filer. This means the same income that was comfortably taxed at 12% is now being taxed at 22% or 24%. The government effectively penalizes the survivor for outliving their spouse. If you don't have a Roth strategy in place before the funeral, it is mathematically too late to fix it. Now, you might be thinking, I'll just keep my income low to avoid this. That brings us to trap number 3, the RMD Cliff. The government doesn't care if you need the money. At a certain age, they force you to withdraw from your pre-tax accounts whether the market is up or down. This is a forced liquidation. If the market has crashed 20% and the IRS forces you to sell assets to pay a tax bill you didn't need, you have triggered a sequence of returns death spiral. You're selling low to pay a partner who takes his cut off the top. But it gets worse. These forced withdrawals trigger trap 4, the IRMA surcharge. This is the stealth tax hidden inside your Medicare premiums. Most people assume Medicare is a flat rate. It isn't. It is means tested. If your income goes just $1 over the threshold, literally one single dollar, your premiums can jump by thousands of dollars a year. It's not a progressive tax. It's a cliff. You fall off, and you don't climb back up until the next tax year. That one extra dollar from your IRA could cost you $4,000 in premiums. So, why is this happening now? Because we're currently living through a tax sale. This is the final trap, the sunset illusion. We're historically at the lowest tax rates we have seen in decades. You feel comfortable now, therefore you're deferring taxes. But the current tax laws have an expiration date. When the sun sets on the current act, the rates revert to their higher historical norms. By deferring taxes today, you're choosing to pay them later at a higher rate, on a larger balance, with a single filer status, while triggering Social Security taxes and Medicare surcharges. You're compounding your problem, not your interest. The solution isn't just saving more, it's tax diversification. You need buckets of money that the IRS cannot touch. Roth conversions, health savings accounts, and properly structured insurance vehicles. The silent partner is waiting for you to retire. The only way to fire him is to pay him off while the price is still low. But to do that, you need to understand exactly which assets to convert first. And that requires a very specific calculation, which I break down in our upcoming video. So be sure to subscribe, and I'll see you there.